Hello and Assalamualaikum. So I will start with part A, identification and explanation of 5 key internal strengths and weakness of Gap Inc. So for the first one is internal strength. So the first strength is its strong brand portfolio. Gap Inc. owns several well-known brands, including Gap, Old Navy, Banana Republic, Athleta, and also Intermix. This allows the company to serve different customer segments from budget conscious consumer to premium and performance to focus shoppers. As a result, the company is not dependent on a single market segment. The second strength is its robust e-commerce infrastructure. Gap has successfully integrated its management information system with its online retail strategy. Customer can enjoy a seamless shopping experience across all brand websites, helping the company remain competitive in today's digital retail environment. So the third strength is the vertical integration of private label production. Since Gap designs and sells its own product, it has greater control over product quality, design, and production processes. This enables the company to respond more quickly to changing fashion trends while maintaining brand consistency. The fourth strength is its commitment to sustainability. Gap aligns its business practices with sustainable development goals, which strengthen its brand reputation. This commitment attracts environment-conscious customer and investor, creating a competitive advantage. The fifth strength is the growth momentum of Old Navy. While some of Gap's other brands face declining sales, Old Navy achieved sales growth. This demonstrates the company's strong position in the value market and provide financial support for the development of its other brand. Next, I will continue with Gap internal weaknesses. So the first weakness is the negative growth of its core brands. Gap and Banana Republic have experienced declining sales, suggesting that these brands are struggling to meet current customer preference and market trends. The second weakness is high geographic concentration. More than 80% of Gap stores are located in North America. This increases the company's exposure to economic downturn, regulatory change, and intense competition within a single region. The third weakness is fragmented organizational structure. The absence of a chief operating officer and the presence of multiple leaders across divisions may slow decision-making and increase confusion regarding responsibility. The fourth weakness is the absence of a formal vision and mission statement. Without a clear long-term direction, it can be more difficult for employees and management to align their goals and strategic decisions. The fifth weakness is its financial leverage and debt burden. Gap carries significant long-term debt with relatively high interest costs. This reduces financial flexibility and may limit the company's ability to invest in innovation, technology, or store improvement.
Hi, next I will present the internal factor evaluation IFE matrix analysis for Gap Inc. The IFE matrix is used to evaluate a company's internal strengths and weakness. Gap Inc. achieved a total weight score of 2.61, which is slightly above the average score of 2.50. This indicates that the company is in a moderately strong internal position and has the capability to compete effectively in the retail industry. Let's begin with the company's strengths. The first major strength is Gap Inc. Strong brand portfolio, which includes well-known brands such as Gap, Old Navy, Banana Republic, and Athleta. This factor received the highest weight score of 0.48, reflecting the company's ability to serve different customer segments and maintain a strong market presence. The second strength is robust e-commerce infrastructure with a weight score of 0.40. This allows the company to reach customers efficiently through online channels and adapt to the growing trend of digital shopping. Another strength is vertical integration of private label goods production, which scores 0.27. This enables Gap Inc. to have greater control over product quality, inventory management, and production costs. In addition, the company demonstrates a commitment to sustainability with a weight score of 0.24. This sustainability initiative helps strengthen the company's reputation and meet the expectations of environmentally conscious consumers. Furthermore, Old Navy's strong growth momentum contributes significantly to the company's performance, receiving a weight score of 0.44. Old Navy remains one of the key drivers of revenue and growth for Gap Inc. However, despite this strength, Gap Inc. also faces several weaknesses. One major weakness is the negative growth of its core brands, particularly Gap and Banana Republic. This factor received a low weight score of 0.14, indicating challenges in maintaining sales performance and customer interest. Another weakness is the company's high geographic concentration in North America, with a weight score of 0.20. This dependence increases business risk if economic conditions or consumer demand in the region decline. In addition, Gap Inc. has a fragmented organizational structure, which may create coordination challenges and reduce operational efficiency across different business units. The company also lacks a formal vision and mission statement, making it more difficult to establish a clear long-term strategic direction. Lastly, Gap Inc. faces a financial leverage and debt burden with a weight score of 0.20. High debt levels may limit the company's financial flexibility and its ability to invest in future growth opportunities. In conclusion, the total IFE score of 2.61 indicates that Gap Inc. has a relatively stable internal position, supported by its strong brand portfolio, advanced e-commerce capabilities, and the strong performance of Old Navy. However, to strengthen its competitive advantage in the long term, the company should focus on improving the performance of its core brands, reducing dependence on the North American market, establishing a clear strategic direction through a formal vision and mission, and managing its financial risk more effectively.
Hi, my name is Muhammad Hakim bin Muhammad Zam, number metric A23B2513. I will continue with the part B. For the question number A is the current ratio calculation. So for the formula of the current ratio is total current asset divided by total current liability, which is the total of current asset is amounted 4,568 million and the total current liabilities is 2,461 million. So the answer of the current ratio is 1.86. If the ratio greater than 1, it means the company is able to settle the short-term obligation of the use of its short-term assets. This situation strong in total indicates the firm has sufficient working capital to conduct activities effectively. For the next question is B, analysis of the quick ratio, which is the asset test ratio. So for the formula of quick ratio is the total current asset minus the inventory and divided by the current liabilities, which is the amount of the answer of the quick ratio is 1.04. This ratio is greater than 1, meaning the company is likely to be able to pay short-term debts if it's liquidated its inventory. Current ratio indicating the inventory contains a substantial percentage of the GAP's current asset. For the third one, C is the debt to asset ratio calculation and financial risk assessment for the year fiscal 2018. And the formula is the total liabilities divided by the total asset, which is the 4,845 millions divided by 7,989 millions. So the answer is 0.606. So the financial risk may emerge from the situation because the ratio greater than 50 means the firm is heavily dependent on debt financing. Higher debt level lead to greater financial risk as the company has to pay interest to repay the debt.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Syarif Ikhwan bin Samsur Razi. My metric number ATTA 978. Today I want to present the calculation of inventory turnover and benchmarking against industry trend for fiscal year 2018 for the gaps included. Okay, today for formula I can use the inventory turnover. Firstly, cost of goods sold divide the average inventory and calculation inventory turnover 19,789 million divide 1997 million. So the answers eventually turnover for 0.19 times because the inventory turnover of 4.19 times show the number of time gaps sell inventory and replace throughout the years. Given the change in the customer stays in the industry where the rapidly of change of is a norm, the slogan that lower inventory turnover time and frequently used gap should have a higher turnover to avoid holding or obsolete merchandise. Okay, next for total asset turnover calculation and infancy assessment for fiscal year 2018. Okay, for the I can use the total asset turnover. Okay, revenue or revenue divide the total assets. For calculation fiscal year 2018, the total asset turnover sales 515,855 million divide 7,989 millions. So the total asset turnover 1.8898 times. So the ratio of the 1.98 indicates the gap achieved 1.898 sale per $1 worth of asset. This shows the extent to which the firm efficient in using its total asset base to generate revenue. Lastly, for conclusion, F, comparative gross profit margin for fiscal year 2000 and 2018, the gap ins. The gross profit margin ratio of gap ins has been on a positive trend with an increase on 1.91%. This growth showed that the companies was able to retain only 38 to 26 as gross profit after subtracting the direct cost of producing of buying the clothing. This indicated the gap increasingly becoming efficient and handling their cost of goods sold COGS structure.
Assalamualaikum. My name is Muhammad Nadas bin Sasude. My matrix number is A23A1565. I will proceed to the next slide. That's Introduction to BCG Matrix. BCG Matrix means strategic management tool used to evaluate business, unit and brand portfolio based on two factors. First, we have market growth rate, that industry activeness and future potential. Second, we have RMSP, that relative market share position, that's competitive strength compared to the large competitor. For category in BCG Matrix, we have star, cash cow, question mark and dot. Star, high growth plus high market share. Cash cow, high market share plus low growth. Generate stable income. Question mark, high growth potential but low market share. Dot, low growth plus low market share with strategy importance. Next, I will proceed to the data analysis from case study. First, we have market growth rate. For a conclusion for overall, market growth rate is a key factor in the BCG matrix because it indicates the activeness and future potential on an industry or brand segment. Among gap in brand, All Navy and Axilia are qualified as high growth brand due to their strong performance and preference in expanding market segment. All Navy in particular achieved a growth rate of approximately 6%, significantly higher than the apparel industry average of 1%. In contrast, Gap, Banana Republic and Assingment fall into the low growth category. This brand face challenges such as judging consumer preference, intense competition, and brand positioning issue. Gap has struggled to maintain relevance among modern consumer, while Banana Republic has faced difficulty in establishing a clear identity in the market. Overall, market growth rate plays a crucial role in determining a brand position in the BCG metric. All Navy and Axilia have stronger growth prospect and may be classified as star or question mark, while Gap, Banana Republic and Assingment are more likely to be categorized as cash cow or dog, depending on their relative market share. This analysis helps Gap in identify which brand should receive investment for growth and which may require restructuring or strategy improvement. Next, data analysis from case study, market share. In terms of the market share, the case study offers the market share of each brand, which in the Gap is one can observe that Gap has the highest market share of 41%, followed by All Navy with 33%, Banana Republic with 20%, Axilia with 4%, and Assingment with 2% of the market share. As such, with the given data, it is not necessary to carry out any calculation manually. As per the case study, All Navy had positive growth plus 6%, while Gap had a negative growth minus 1%, and Banana Republic also had negative growth 2 minus %. The growth rate of the whole clothing industry is estimated to be around 1%, which proves that the industry is mature. It is worth mentioning that the exact growth rate of Axilia cannot be provided since the company operates in the sportswear segment, which has higher growth than others. Next, I will proceed to data analysis from case study about the relative market share position, RMSP. The formula for RMSP that brand market share divide largest competitors market share. In this case, the largest market share belong to Gap, which 41%, so all other brands are compared against this figure. Starting with Gap, the RMSP is 41 divided by 41, which equal 1.00. This indicates that Gap is the market leader and serves as the benchmark for comparison. Next, All Navy has a RMSP of 30 divided by 41, which equal 0.80. This shows that All Navy has a strong market position, but it is still slightly behind Gap. For Banana Republic, the RMSP is 20 divided by 41, resulting in 0.49. This means its market share is less than half of the market leader share. Moving on to Axilia, the RMSP is 4 divided by 41, which equal 0.01. This indicates a relative weak market position compared to Gap. Lastly, Assingment has a RMSP of 2 divided by 41, giving 0.05, which is the lowest among the brand analyzed. In conclusion, a higher RMSP value indicates a stronger competitor position in the market. Based on this analysis, Gap is the stronger brand, followed by All Navy, Banana Republic, Axilia, and Assingment. Therefore, Gap maintains the dominant market position with the company brand portfolio.
Assalamualaikum, my name is Mufazi binti Muhammad Salim. My matric number is A23A1844. So today I will present about the strategic implication and recommendation for Gap Inc. brands based on the BCG metric classification. So based on the BCG metric shown on the screen, Atleta is classified under the question mark category, All Navy under the star category, Gap under the cash cow category, while Banana Republic and Assingment are classified as dogs. First, Atleta is classified as a question mark. This is because Atleta operates in the rapidly growing activewear industry but only holds a small market share of 4%. Although the growth potential is high, the company still faces uncertainty in deciding whether to invest heavily to increase market share or reduce operation due to high competition costs. Therefore, Gap Inc. should focus on market development strategies such as expanding into new geographic markets and strengthening its distribution network. So, Atleta also needs strong investment in marketing and research and development to improve competitiveness. The company should continue targeting niche markets by offering premiums and high-quality women's activewear products. If managed effectively, Atleta has the potential to become a star in the future. Okay, so next, Old Navy is categorized as a star because it has the highest market share of 33% and continues to experience strong growth. This shows that Old Navy is highly competitive in the budget clothing segment. To maintain this position, Gap Inc. should continue investing in expanding physical store and improving digital infrastructure. The company should also strengthen marketing strategies to attract new customers and maintain customer loyalty. Besides that, continuous product development and introducing products based on current fashion trends are important to ensure Old Navy remains competitive in the market. Okay, so now moving to the Gap brands. So the Gap brands is classified as a cash cow. This is because Gap holds a high market share of 41%, even though the industry growth rate is negative. The brands remain stable and generates consistent cash flow for the company. So Gap Inc. should apply a harvesting strategy by minimizing unnecessary investments while maximizing profits. The cash generated from Gap can then be used to support higher potentials brands such as Atleta and Old Navy. At the same time, Gap should continue selective product innovation to ensure the brand remains relevant among modern consumers. So lastly, Banana Republics and Intermix. Okay, so Banana Republics and Intermix are classified as a dogs because both brands have low market share and negative growth rates. Due to these positions, Gap Inc. should consider downsizing operations by closing unprofitable stores and reducing operating costs. So for Intermix, the company may consider a disposal strategy so that resources can be redirected to stronger brands. Meanwhile, Banana Republic may need product repositioning strategies either by maintaining its premium image or shifting towards a more affordable segment to attract consumer again. In conclusions, each brand within Gap's portfolio requires different strategies based on its position in the BCG matrix. By implementing suitable strategies actions, Gap Inc. can strengthen its competitiveness and achieve long-term business growth. So that's all for me. Thank you.